Hey all, welcome to ShareTreck where science meets investment, and I'm your host Raj. Friends, I'm a Canadian and this topic is important for me and to all investors that are not American tax residents. So please watch till the end if you are not an American. And today we are diving deep into a potential major shift in US tax policy that's getting surprisingly little attention due to its potentially massive implications for investors. It was buried deep inside the big beautiful bill and has been recently discovered. Global capital flows and America's trading relationship will be impacted by this. I am talking about Section 899, a controversial new clause in President Donald Trump's 2025 One Big Beautiful Bill tax reform. At first glance, it sounds just like another tax on the books, but don't let the dry title fool you. Section 899 could act as a financial boomerang, targeting foreign countries that tax US firms, but potentially ricocheting into Wall Street and Main Street alike. Let's explore what it does, who it affects, and what it could mean for your investment as a foreigner investing in the United States. At its core, Section 899 empowers the US Treasury to impose an escalating surcharge or surtax up to 20% on income earned by foreign individuals and companies from countries that, in the US's view, unfairly tax American firms operating abroad. These unfair taxes include digital services taxes, the OECD's undertaxed profit rule or UTPR, and diverted profit taxes. Countries using these tools include close US allies like UK, Canada, of course, France and Australia, as well as nearly all the EU members. The tax starts at 5% in the first year and increases by 5 percentage points each year until it hits a ceiling of 20%. This will be applied on top of existing US tax obligations and cover income like dividends, interests, rents, royalties, and some capital gains. To give you a real sense of the impact, a foreign investor earning 100,000 in US source dividends could pay an extra 170,000 over a decade. That's on top of all standard US withholding taxes. And the scope is very broad. Please check out this chart I have on the screen and see if your country is included in it. While the bill is framed as a counterattack against foreign governments, its scope is wide. It's wide enough to ensnare many unintended targets. Passive investors like pension funds and ETF holders aren't even exempted, nor are international mutual funds or even sovereign wealth funds that passively hold US stocks. That's a big reason why fund managers, including the Investment Company Institute, are lobbying Congress to amend or narrow the law. Their concern is that foreign capital might begin to exit US markets simply to avoid this surcharge, which could hurt liquidity, suppress valuations, and make US assets less attractive on a global scale. Well, friends, let me take a small segue. If you find this breakdown helpful so far, please hit the like button. It really helps my channel with the algorithms and helps other people like you discover ShareTreck. That said, let's look at the real world impact. Let's take that earlier scenario a step further. If you are a fund in France earning $1 million annually in US dividends, by year 4, you are paying $200,000 in additional taxes. And once the rate stabilizes at 20%, that's an ongoing hit. Year after year, you pay 20%. Multiply that across thousands of institutions and individual investors, and you can see how it might not just deter new investment, it could unwind existing positions too. There's more at stake than just market mechanics. If foreign investors reduce or withdraw their position in the US stock markets, the knock-on effect could include lower liquidity in equity markets, downward pressure on stock valuations, decreased demand for IPOs or capital raises, and even potential job losses if multinationals begin relocating their operations to countries with friendlier tax environments or opening cutting-edge new subsidiaries in friendlier tax locations. And while Section 899 is designed to punish foreign countries, there is a growing risk that it triggers retaliatory taxes on the US investors abroad, setting off a global tax war that no one wants, but everyone may get caught up in. One of the more troubling parts of Section 899 is how many open questions remain. For instance, there is no firm legal consensus yet on whether US Treasuries and corporate bonds will be exempt due to portfolio interest exemption. Most experts agree equity will be subject to surcharge, but the administrative burden for identifying, reporting all affected income streams could be enormous, especially for withholding agents and financial institutions. The bill does not allow a transition period until the end of 2026 to get compliance systems in place. But that's a tight window for something with this many technical and legal complexities. Also, this means above the tax, you have cost overheads to calculate, submit, and maintain compliance records for this tax. The Joint Committee on Taxation expects this provision could raise $116 billion over the next decade, but for context, that's relatively modest compared to US tariff revenues, and it's not clear that revenue gain offsets the potential market disruption, reputational harm, or international friction. What's more, the entire bill, while politically framed as a pro-American, may ultimately reduce US competitiveness if it makes investing here more complicated or punitive for foreign capital. This is also contradictory, I think, to the administration's objective of attracting foreign investment to build factories in the United States and to produce everything in America. Guess what? That huge investment will get taxed at 20% in the long run. And who wants to do that? In closing, I would say that Section 899 represents a dramatic and arguably aggressive shift in US tax policy. While the goal is to defend American firms from what the government views as discriminatory taxation abroad, the fallout could hit US markets just as hard, if not harder, than the foreign governments it's aimed at. The Senate has not yet passed the bill, so there is still time for changes. But the debate is heating up, and for global investors, the risk calculus around US assets may never be the same. Also think about the institutions which are charged with withholding this tax. I was a project manager in the banks, and I was in wealth management projects. I can imagine the problem that subject matter experts would face in giving specifications for modifying existing back office systems to do these kind of tax withholding. So that said, friends, I think I would like to say thanks for watching this video if you have been following so far. And if you have not yet subscribed, can you please subscribe and help grow the channel? At the very least, if you like this video, please press the like button as it helps me with the YouTube algorithm. That brings me to an end of this video, my friends. I'll catch up with you again in the next video. Bye for now.